The Fed is changing its forward guidance language somewhat. They are insisting that the Fed can be patient in deciding when to raise interest rates, but they are further saying in their statement that that is consistent with their previous language, that they can wait a considerable time before raising interest rates. Let me walk you through the statement. There is some new language on inflation and the economy, modest changes there, and there were 3 dissents at this meeting. Not everyone's happy with the forward guidance changes. Let me read directly from the statement here, the forward guidance. Based on its current assessment, the committee judges that it can be patient in beginning to normalize the stance of monetary policy. The committee sees this guidance as consistent with its previous statement that it likely will be appropriate to maintain the 0 to 0.25% target range for the federal funds rate for a considerable time following the end of its asset purchase program in October, especially if projected inflation continues to run below the committee's 2% longer run goal, provided that longer-term inflation expectations remain well anchored. So they have left considerable time in here, but they have used it to basically condition their new language with regard to patience. Now, as to the economy, minor changes here. Labor market conditions improve further with solid job gains and a lower unemployment rate. On balance, a range of labor market indicators suggests that underutilization of labor resources continues to diminish. We have similar language on household spending and business fixed investment. Some new language here on inflation. The committee expects inflation to rise gradually toward 2% as the labor market improves further and the transitory effects of lower energy prices and other factors dissipate. The committee continues to monitor inflation developments closely. Let me read you the dissents, because certainly it will be notable that there were 3 dissents here. All 3 of these folks will not be on the FOMC as voters next year. Richard Fisher, he dissented. He believed that while the committee should be patient in beginning to normalize monetary policy, improvement in the U.S. economic performance since October has moved forward further than the majority of the committee envisions the date when it will likely be appropriate to increase the federal funds rate. Narayana Kocher-Lakota, a different dissent, believed that the committee's decision in the context of ongoing low inflation following market-based measures of longer-term inflation expectations created undue downside risk to the credibility of the 2% inflation target. And Charles Plosser believed that the statement should not stress the importance. The passage of time is a key element of its forward guidance. Given the improvement in economic conditions, should not emphasize the consistency of current forward guidance with previous statements. So clearly some criticism of the language in here, but this is how the Fed is moving forward. And let me share with you as well some of the projections. This is, of course, the quarterly meeting where they unveil their projections for what's forthcoming in terms of rates and the economy. The new forward guidance here, or the explicit changes here with regard to where they see rates. 15 of 17 Fed policymakers now see the first rate increase in 2015. That's not all that different than what we saw before, but the pace of that firming has changed. The median forecast now shows that the Fed funds rate, again, according to their projections, at the end of 2015 will be 1.125%. That is lower than the 1.375 that we saw previously in September. By the end of 2016, the median, again, forecast here, 2.5%. By the end of 2017, the Fed funds rate they see 3.625%. Other highlights, they see GDP next year, fourth quarter over fourth quarter, rising as high as 3%, growing as fast as 3%. GDP for 2015, again, 3%. And unemployment next year as low as 5.2%. So they could hit full employment as soon as next year. Inflation they see as low as 1% next year. That's a big drop, almost entirely accounted for by energy prices. They see inflation hitting their 2% target as soon as 2016. So, Mark, a lot to digest here in these projections as well. This new forward guidance from the Fed seems like they try to satisfy everyone, perhaps, and give themselves a little bit more flexibility.